Hi, everyone. This is Tim McCusker, Chief Investment Officer at NEPC. Thanks for joining us today for our 9th annual Investment Manager webinar. This has been a great way for us to share information with the manager community, provide some transparency both into our process and into our team on who's covering strategies. So we're excited to do that once again. We will have some time for questions at the end. I believe in the bottom right of your panel, there's an area where you can type in questions, and we'll try to get to those at the end of the session. Our goal in working with all of you is to have a great partnership and to deliver innovative and high-quality investment strategies to help our clients meet and exceed their goals and objectives, whether that's helping folks retire with dignity, deliver on a charitable mission, or funds healthcare obligations or healthcare initiatives within those types of organizations or with individual families. I think for us, we want to be partners with the investment managers that we work with. I think what we're looking for is a win-win-win where our clients can achieve their objectives, feel like they're getting what they need from their consultants and their managers. We can deliver the right asset allocation and manager selection to help them hit those objectives, and managers can deliver great performance as part of that. And if that's happening, I think the clients are happy, we're getting fair and reasonable fees for our work, and managers are too. I'm joined here today with Sarah Samuels, our new partner and director of traditional research, and Alyssa Howard, a consultant on our hedge fund team, who's been with us for 8 years and knows her way around the entire research organization. So she'll be talking about our process and our coverage. My plan was to give an NEPC update, talk a little bit about what we're seeing in investment markets, but also what we're seeing with clients and some of the risks and concerns that they have. Alyssa will go through our coverage and process, and then Sarah will talk about our search activity, what we saw over the last year, some key initiatives that we're working on, and to wrap up before we get into some questions. So in terms of NEPC, it's nothing crazy, nothing wildly different from the last time we did this webinar. We're at just under 300 employees with 8 offices across the United States, 366 clients, and around $1 trillion in assets under advisement. You can see in the pie chart on the lower right that it's a very balanced mix of client types. And I think we are unique in the consulting industry in the breadth of our types of client relationships. We feel like we have leadership positions in the consulting space in each of those areas. That's a challenge for us in research. We've got to meet the needs of a very diverse set of clients, but it's also really exciting because we get to solve lots of different kinds of problems, and it gives us incredible perspective across the entire investment landscape and across the entire client landscape. You can see in the subtext down below, of that $1 trillion and 366 clients, 55 of those clients are working with us on a discretionary basis, representing a little over $20 billion in assets. So that's been an important growth area for us, and a new and interesting way that we have worked with investment managers over the last 8 years that business has been in place. I'll talk a little bit more about that. Our focus in working with clients, just to review the value proposition that we bring to clients, is to feel small but be big. We want our clients to feel like they're working with us and they're our only client relationship. We're dedicated and focused, and we try to staff our consulting teams so our consultants aren't overwhelmed with 15 or 20 relationships for a consultant. We want them to really be able to focus on each client and to be able to dive into the complexity of each client situation and to understand the segment needs. A healthcare organization is going to have very different needs, very different objectives and risks relative to a public pension or a family office. And we want folks that can have that expertise in each area. And we want a research team that can find really interesting ideas regardless of our size. We want to be able to uncover some of those really interesting things, innovative and new things that are happening in the investment space. At the same time, we want to have deep resources to deliver comprehensive services to our clients. We want everything to feel customized, but we want to have the breadth behind our consultants to scan the world, cover research globally, to scale our research, get manager fees right-sized using our size, being able to offer you significant assets from our clients, and in return, have commercial arrangements that make sense for both sides, getting better access to innovative strategies, and then, as I said before, with that breadth, being able to see learnings and insights from across our client segments and apply those in different ways. A great example of that over the last 5 years is ESG, which Sarah will talk a little bit about. That was an area that really gained momentum first in the endowment foundation and maybe family office space. We saw that as an emerging trend. We reacted to the demand in that space, and now we're seeing it across lots of other client types, and it's becoming an increasingly important part of our overall research process. So I'll turn to a market outlook first, the client outlook, what we're seeing from clients, and we'll use some information from Greenwich to talk about this. This is a question of key challenges for institutional investors, and really interesting the way the concern around rate of return and funding issues has shifted. It is still the #1 risk across clients, but you can see how much that's gone down. Maybe that's just a result of really strong returns and a bull market for over a decade, but it's dropped by 17% from 16 to 18, and has shifted a lot across client types. If we look at corporates, a decade plus into the Pension Protection Act, being required to fund, having excess cash due to good profits, they've been able to fund up their pension plans generally and have less concerns around the rate of return or future funding, while that's still an acute concern for publics and E&Fs as well. Biggest concern for E&Fs is in asset allocation, actually. Asset allocation, the driver of returns, continues to be a major concern, and then market volatility and risk management. And this survey is done in the early to mid-fall, so you think about the timing of this was actually a little bit ahead of the market downturn that we saw in the fourth quarter, maybe just at the beginning of it. But even before that happened, clients are getting worried about volatility and being able to manage the risks they have in their portfolio. They're seeing that we're in the late cycle of a long-term investment cycle and wondering how much longer that can last, and thinking about ways that they can position their portfolio to succeed in that late cycle environment. In terms of activity, what investors are expecting to move around in their portfolios over the next 3 years, you can see a general trend with reductions in equities, tying back to that idea of better risk management, trying to get more diversified and balanced. A continued trend out of U.S. equities in particular. Interesting that both active and passive are seeing downward trends here, where the last few years there's been much more of a shift out of active into passive. You can see the expectations are that it will be roughly similar activity across those. A big uptick in active fixed income as investors continue to search for yield, and then the continued trends of direct private equity investments, and here that means into direct funds, of course, not direct investments into companies, but a movement away from fund to funds into the direct investing space, and that's been happening for several years now, and we expect that to continue, or investors expect that to continue. And then a perspective that I think is really unique for NEPC to work across all these client types. So this picture summarizes the great thing about working in research at NEPC and working for NEPC, but also the challenge, the wide variety of client types and the different needs that they have. Even this chart doesn't tell the whole story. You can see corporates and healthcare maybe don't look that much different, but that 41% in fixed income for corporates is a much different structure than most of the others, where it's largely long duration, trying to risk manage the liabilities. Publics have increasingly seen alternatives increase, in particular private equity, as they haven't done as much in hedge funds, and then the heavier weight in alternatives in endowments and foundations, and types of managers that they're looking for in that space, looking for higher tracking error, smaller managers compared to larger, more established, more risk-aware managers in the public and union space. In terms of our outlook, it's in line with that idea of the late cycle, We definitely see indicators that tell us we are in the later stages of the economic cycle. Towards the end of 2018, or throughout 2018, we saw tightening global liquidity with the Fed continuing to raise rates. We've seen that paused a little bit as the Fed has said they're not going to do anymore. The ECB and the Bank of Japan doing whatever they can, as limited as that is. But we do see overall still a tightening global liquidity environment, just somewhat de-emphasized relative to the end of 2018. Transitions in China continue to take place, and China continues to manage those effectively. They've gone from tighter policy to somewhat looser policy as well. They've got multiple transitions going on there. They're going to have an impact on the global economy. An area of focus for us over the next few years will be doing research in China, trying to find interesting strategies to invest in China to bring back to our clients. And then a multi-year theme of globalization backlash, where we're seeing populism play out in polls. We're seeing trade wars, although starting to believe that there'll be some resolution to that, although with an election picking up, that will probably continue that populism wave. So tying those key themes together, the opportunities that we see are first, to rebalance developed market equities. Investors that were able to do that in January have certainly benefited, but that also means making sure sizing of U.S. and non-U.S. makes sense. We had a view that was positive and constructive on EFI markets. We've backed that off and think you should be closer to market weight on U.S. and non-U.S., so having an overweight on emerging market equities. We do see, being in a late cycle environment, an opportunity to try to raise safe haven fixed income exposure and bring down lower quality credit exposure. And then those still looking to take meaningful risk, we're looking at more nuanced ideas like adding long volatility exposure to take advantage of spikes in volatility, funding public midstream energy like MLPs, and then emerging local currency debt. So certainly there'll be opportunities for questions on that if there are questions. But with that, I think I'll turn it to Alyssa to talk about our research coverage and process.
Great. Thanks, Tim. All right. I am going to briefly go over the overall research team and dive a little bit deeper into the traditional and hedge fund teams, and then walk through a quick overview of our research process. So first, you'll see the overview of our full research team. We have over 50 individuals here represented in 6 main groups of research. Down the center, you'll see the traditional research group headed by Sarah Samuels, who you'll hear from momentarily. To the right of that, we have alternatives, which is broken down into hedge fund research and private markets, which is further broken down to private equity and real assets. In real assets, we've had a recent add in this group, Chris Myers, who's joined us as a senior consultant, and he is going to be focusing primarily on real estate research. And then within private equity, we've had Josh Beers join the team as well, and he's been focusing on venture. You'll see 2 newer boxes within this page, and you'll see the taxable research headed up by Christy Hansen. That isn't technically a new group, but we've added resources to that as Brendan Jones has shifted his responsibilities to that team. He's focusing primarily on munis, but will support the whole taxable research effort as our private wealth group continues to expand. The more new group that just started this spring that Sarah, again, will go a little bit more into detail on later in this call is Portfolio Construction Group. That's headed by Tim Bruce. That is 4 dedicated research resources to portfolio construction that will be working across groups, so with our client teams, with research, and then also directly with our clients. So that's a new important initiative for us, and hopefully streamline some of our processes and create better portfolios going forward. So next, we have the overview of our traditional research team and each researcher's individual coverage. I'm not going to go into every line here, but just to kind of highlight some of the ideas on this page. First, we have Kirsten Christensen, who covers U.S. large cap and global equity. She's actually spending a lot more of her time on the global equity space these days, as we've gone more passive in U.S. large cap. We have Haley Tran, who's covering emerging markets equity and emerging markets debt. And we've added Steph Lyons on the fixed income side to help support our effort in that team. We place more emphasis and individual research on the index and custody services with Roseanne Holleran, formerly Morello, and that's just to have a more dedicated and consistent coverage of those spaces. And then finally, down at the bottom, we have Tim O'Connell, who's covering equities broadly, and his focus is more on sector funds, regional funds. In particular, he's been spending a lot of time on China, an initiative that Tim spoke about earlier. And then into the hedge fund team. So this group can really be broken down into 5 distinct groups. We have Equity Linked, which is headed by Andrew Pedersen. He's spending a lot of his time, again, like Tim, on sector focus and regional funds. Within Credit Linked, it's headed up by Amanda Carlson, spending time a lot on structured credit opportunities. Event Driven is headed by Delari Pancholi, who also heads up a lot of our efforts in ESG, but she also spends time in the event-driven space and has been focusing on smaller managers and new launches. Global Macro, that is my area of focus. I'd like to think I spend a majority of my time these days focused on volatility strategies, another one of our key themes that we've identified over the past 18 or so months. Then finally, within multi-asset, we have Reno Eklord, and this kind of more broad group encompasses a number of strategies, but primarily multi-strategy hedge funds, alternative beta, and risk premium. And finally, this whole group is supported by an operational due diligence team headed by Bill Bogle. And here we've had a new addition in the past year of Catherine Hull, who has joined us in our Portland office. Great. I'm going to do an overview of our manager research process. And what our manager research process is really is a top-down and bottom-up idea generation process. So, for example, we can look across asset classes and markets and identify different opportunities that we want to find managers to execute upon. So after refining an idea, we then need to generate this universe. We do this through our deep industry networks, to our clients who often have deep relationships with managers that we can leverage. We do use database screens, and we have developed some strong relationships with third-party capital introduction teams. Once we've generated this universe, we dive into the quantitative and qualitative due diligence process. First is the quantitative. This can vary by asset class from traditional markets. We do have a proprietary screening process using a tool called PASS that helps us analyze performance and dig deeper into the different rankings of managers. Within the less liquid space in hedge funds and private markets, I think we spend a little bit more time on attribution analysis and understanding what the drivers of returns have been over time. But throughout this process, it is about generating a peer group and understanding where managers fall, and that leads well into the qualitative due diligence and understanding what's creating those types of rankings. So in the qualitative due diligence, the key to this is to determine if what is making the strategy succeed is both sustainable and repeatable. So we do this through multiple calls, on-site meetings with key professionals. We bring our findings and our ideas to our teams for discussion to flesh out the investment thesis and understand the opportunity. And then we often engage with the operational overview. And again, this is a little bit more extensive on the hedge fund side. Once that vetting has been conducted, the researcher brings their strategy or strategies for the proposed rating to one of our 2 investment committees. We have the due diligence committee, which rates our traditional strategies, and the alternative assets committee that rates private markets and hedge fund strategies. And again, a researcher is coming with a proposed rating, but it is at the ultimate discretion of these 2 committees to determine the rating. And finally, once a rating has been determined, there is the ongoing monitoring process. And again, this varies by asset class of frequency and depth, but it is a general understanding of what's driving performance, what's going on in markets, and then the ongoing identification of different sorts of due diligence events and firm changes at each underlying manager. And I just mentioned ratings a couple of times, and we wanted to reiterate a change that we we implemented last year, and we went over this in this call last year as well, but just wanted to talk about it once more. We moved our rating system from this preferred, neutral, not recommended, to a 1 through 5 type of rating system. And this allowed us to still have a way of saying that we have our best ideas, and that's the 1 rating, but also gave us the latitude to rate more managers if we needed to, and to formally document our views in formal ratings. So again, this is something that's been in place for about a year, and I think it's been well received by our clients, and I think it's been well received by the research team as well. And with that, I will turn it over to Sarah.
Alyssa, as you're handing it over to Sarah, just a reminder to everyone that if you do have questions, please feel free to go to the bottom right of your screen and type those in.
Great. Thanks, Alyssa and Tim. This is Sarah Samuels, and I'm going to start my comments to give an overview of our search activity in the last year. We conducted 640 searches in the last year, representing $25 billion in assets invested. That is down from both 2018 and 2017 in terms of both number of searches and dollars invested. But those numbers can move around quite a bit due to large clients who may swing these numbers with big, chunky activity. Some themes that we can see on this page that we could talk about over the last 2 years, some of these same themes have been in place, including high search activity in international equities, global equities, and emerging market equities. On the domestic side, we continue to see a downward trend, so going in the other direction, in U.S. large cap activity, and we've actually seen nearly an 80% drop in search activity in U.S. large cap equities year over year. If we tie back to the Greenwich data on page 10 that Tim was talking about, which outlines our the institutional investors' expected asset allocation shifts in the next 3 years, this downtick in activity that we're seeing reflects this trend real time. Fixed income search activity really hasn't changed much year over year. If we look to the private markets, particularly private equity, we continue to see high search activity here. And this could be a combination, we think, of a couple of things. One is that clients are ramping up their exposure to private markets in search of that illiquidity premium and return premium over public markets. And it's also a reflection of the different cadence that private fund vehicles have coming back to market every few years to fundraise. This page here shows us a historical perspective by calendar year. And you can note here that from 2014 to 2017, we did see an increase in search activity. And that can really be attributed both to large clients conducting searches and manager events like personnel changes or major performance issues where clients are looking to change up their manager lineups. Moving on to key initiatives, we have a number of really exciting things that we're working on this year. The first is the portfolio construction team that Alyssa mentioned. Earlier this year, we created a new group within NEPC called the Portfolio Construction Team, and the reason we did this was really to deliver a fuller solution to our clients by bridging the gap between asset allocation and manager selection. This group's charter is a really important one, and although it's early days, we anticipate that this team will help clients build multi-manager lineups, think through risk and factor exposures, and advise on active versus passive, among other things. It's important to note for the investment managers and the investment manager community that the portfolio construction team won't affect how you interact with the research team. The portfolio construction team will be focused on helping clients with portfolio matters behind the scenes. So it's really business as usual in terms of your interaction with NEPC. Another area of focus that you heard us talk about last year is our continued focus on fees. Our priority really is to partner with investment managers to structure the most economically favorable agreement as possible for our clients. We recognize that fee compression is difficult for managers, as it is for NEPC as well, but fee negotiations really are a major trend that are being driven by the asset owners themselves. We've had great success working with investment managers to come up with creative fee schedules that align the interests of managers and clients while still allowing managers to operate and run their business as they need to. We're open to thinking outside the box with different fee managers. We're open to performance-based fee structures that better align incentives. In the private markets, we've had some success in reducing management fees while increasing carry to better align incentives. And in the hedge fund and private market space, we've introduced hurdles and pref rates where they don't exist currently. So all of these structures reward managers for exceeding expectations, which is what we all want. We turn to the next page, looking at this fees in action here, and looking at some of the progress that we've made in getting negotiated fees for our clients. Last year, we increased by nearly twofold the numbers of one-rated managers or strategies offering fee discounts, from 80 strategies to 150 strategies. So we'd like to thank all of our partners on the phone and those who aren't today who have evolved their fee structure in partnership with NEPC. This has been a big initiative for us, especially on the front end as we're doing diligence on new managers. And it's going to become more of an evergreen approach where we continue to work with managers on fees going forward. As Tim alluded to, ESG is a really important trend in the investment industry, and it's important to our clients and to NEPC. We're committed to ESG integration, and I can say that having recently joined NEPC from the outside, NEPC is at the forefront amongst our peers in terms of the work that we're doing here. We've developed an ESG rating system, which is alluded to on this page 26. This ESG rating system is now integrated into our overall research process. So if you haven't already, you should expect to hear from our research team at some point over the next year or so as we roll out this ESG rating initiative more broadly. And we'd like to thank you in advance for your support here and working with us to understand how you're integrating ESG into your processes. For those of you who want to reach out to NEPC to discuss our ESG efforts, Chrissy Pelletier and Delari Pancholi lead our impact committee. So just to wrap up with some final thoughts, we invite you all to keep current on NEPC's views, which can be found at nepc.com. We put a lot of content out each year, and this can be really informative as to how best to interact with our research team. More is not always more, whether it's touch points with research or investment strategies that you'd like us to evaluate. So we really do want to hear your best ideas always, and this generally means quality over quantity. We talked about our fees and the competitive pricing that we seek to bring to our clients. And finally, we believe that there's value for both parties in a quick no when the strategy isn't the right fit for us. And we appreciate your ongoing respect here. So with that, we're happy to take questions from the investment managers on the phone.
Great, and we do have a few here. First, and thank you to everyone who has submitted questions. First is one for Alyssa. We're lucky today that it's a question on an area that you happen to cover. Where would systematic global macro strategies fit in your search activity page? I don't think we need to go back there, but I imagine the subtext is there. The subtext of that question is also, are we seeing activity in systematic global macro?
Sure. So the number would be embedded in the hedge fund number specifically, and we see kind of varied experience in that space. We've seen some people move completely out of systematic global macro, more focused on the trend following strategies that they have become a little bit fatigued with, but we've seen some clients shifting their exposure to other managers. So we do expect that to pick up going forward as we hope those strategies come back into favor if and when volatility really returns to the market. So it has really varied client type by client type, what type of search activity we're seeing in global macro systematic strategies.
Great. A few more technical questions here. Is the slide showing allocations to equity versus alternatives? I'm guessing that this is the Greenwich slide that had asset allocations. Does equity include PE, or would that be an alternative? I can't say with certainty, but my my understanding of it is that private equity is in the alternatives bucket, not part of equities for that slide, where you saw 40 to 50% type equity allocations. I believe that was public equities. Another one that I can take, do you disclose the ratings to a manager? There's no policy where we're saying that we won't do that. We also don't have a formal mechanism or medium where we can share that systematically with everyone. I'd say if you're unsure, you should feel free to ask your coverage person. I would also say, if we're going through the process of underwriting a strategy, you're going to know that that's going on. That's not some cryptic thing. That's a fairly thorough process, and we're probably going to be following up with you to let you know how that went and if it got through the due diligence committee. So we're very happy to be transparent on that and share that with you. Let's see, in real time here. The global international EM search has been high. Can you give an approximate breakout percentage-wise? I'd love to give that to Sarah, but she just joined a few weeks ago, so doesn't have the history of the last year. I don't have the numbers, but my guess would be that it's heavily tilted towards global. We've done a lot of global activity and have seen a lot of success from managers. And then secondly, EM, with less activity in international. Probably, I would guess, over half of the activity there is in global, then maybe a third in EM and a small balance in international. Alyssa, another one for you, without revealing manager names. What types of long vol strategies are we recommending?
Very relevant question. So right now we're just offering one long volatility strategy that's rated to our clients, but it's an area of a lot of activity for us on the research team, and we're looking to underrate a couple more strategies within that space. And the idea being having some strategies that are more equity focused and protecting in equity markets, but also ones that are multi-asset. As we're seeing volatility, we'll see volatility return to interest rates and currencies as well. We're also looking at more of the relative value opportunities within volatility as that continues to persist. But generally, I guess the answer is either equity-focused ones or multi-asset approaches.
We have two final questions here. One is, how do you determine how many managers you will rate under each strategy type? And this has been we've had some formal ways of doing this to manage the amount of coverage that we have. But also, I think it's more of a feel of how much demand there is in an asset class. So for the traditional space, we've generally tried to have anywhere from 6 to 10 managers on a preferred list as one rated within an asset class. I would say that is stretching us pretty thin to do that, and we're looking at one of Sarah's initiatives is to look at how we do that going forward, and if we want to slim that down, and where we really want to be taking active risk. It's also a matter bottom up of making sure that we have diversity of different strategy types. So there's not a specific number. It's really by asset class and how much opportunity we see in an asset class. If we don't see a lot of compelling managers, we're not just going to fill a list of 8 managers just for the heck of it. And then just one last one, an important one. I want to make sure that I say, because I didn't say it at the beginning, there's a question about whether we provide this information. So we will post this presentation on our website, and you'll be able to access it, access the recording, and you can pause and see the coverage by asset class, so you know who to talk to. So I want to thank everyone for joining us today. Thank you to Sarah and Alyssa for sharing some thoughts on the research team. We really appreciate the partnership that we have with the investment manager community, and look forward to continuing that for many years to come. And if you have specific questions, you should feel free to follow up with the appropriate research person. So thank you, everyone, and have a great day.